Coming up on today's episode, stocks finish lower on the back of Fed minutes and weaker data out of China. The Fed says they see more rate hikes ahead but at a slower pace. Goldman Sachs says now is the time to hedge your portfolio. Another warning on the credit markets from a billionaire. And the market continues to coil up on low volume, but we did get a rise from the VIX today. Welcome back to Click Capital, everybody. I hope all my American friends had a great 4th of July holiday. And if you're new to this channel, welcome, and don't forget to hit that subscribe button, as every day after market close I make these daily analysis videos where I go over all the most important data, news and charts from the markets to keep you informed of what's really going on out there. So hit that subscribe and these videos will show up on your YouTube home screen every day when you log in. And so it was a bit of a mixed day out there in the markets. We did see a bit of weakness in the semis and a bit of strength in the utilities, but overall it was a bit of a down day across the board. And I think why the market was a little soft today is we got the FOMC minutes. It gives us some insight into what the members of the Federal Reserve were talking about at their last meeting. And it showed there was some disagreement among members, and all but 2 of the 18 participants expected that at least 1 hike would be appropriate this year, and 12 expected 2 or more hikes. But they're largely in agreement that they needed to slow pace of tightening, which had been one of the most aggressive hikes we've ever seen. And so they just wanted some additional time to observe the effects of all that tightening and just kind of let that flow through to the economy, as there is a bit of a lag on when the Fed hikes rates and what it does to the economy. What may have also upset the market today was we got some weaker economic data out of China, with their purchasing managers index, the PMI, dropping to 53.9 in June. That's from a 57 in May. And so we had seen in recent weeks the Chinese drop their interest rates and were trying to re-stimulate their economy after their initial burst from their COVID reopening has kind of worn off now, and it looks like things could be turning back down again over there. And that obviously has a big impact on global growth and demand for commodities and other things as the world's second largest economy. And we've got Goldman Sachs saying investors should take advantage of the recent rally in stocks and prepare for losses by buying insurance. They said the narrow leadership from mega cap tech stocks means the downside risk is elevated, and they go on to give 5 reasons why now is a good time to buy insurance, with the first being downside protection is attractively priced. The second being the narrow market rally suggests drawdown risk is elevated because historically sharp declines in market breadth have typically been associated with large drawdowns in subsequent months. The third reason being valuations are high in absolute and relative terms. So while we can see most of the S&P 500 is trading around its median average PE valuation of 17 times, mega cap tech stocks are trading 30, which is well above their median of 24 times. The fourth reason they said is equities are already pricing in an optimistic outlook, and they project if we do get a recession, we'll see the S&P 500 at 3,400 next year. And their fifth and final reason is positioning is no longer a tailwind to equities. In other words, a lot of people on the sidelines have jumped back into the market, and we're seeing a lot of bullish sentiment readings out there. We've also got billionaire hedge fund manager Brian Higgins saying the credit markets will soon look like a slow motion car crash. And this is from a guy who made billions in the aftermath of the 2008 debt crisis. He described opportunities in the market as a walk, don't run situation. And that's because him and a few others think the effects from those regional banks failing earlier this year haven't fully played out throughout the system with tighter lending and credit. However, as we know, the stock market is ignoring that, and we've also got the risky end of town and bonds ignoring that as well. As highlighted by this chart here, the junkier the better. Corporate bonds with the lowest credit rating outpacing investment grade rivals. So we can see this year, CCC rated debt is up 10%, where AA rated is up just over 2.5%. We also have seen stocks with the weakest balance sheets are beating those with the stronger balance sheets, which is a strange dynamic in a rising rate environment, as companies with a lot of debt and low cash flow are going to suffer the most if we do go into a recession and we see that credit crunch. There wasn't much out in terms of economic data today. We got those factory orders month over month coming in a bit weaker than expected, and we're going to get a bunch of jobs data tomorrow and going into the end of the week that we'll be paying attention to, like the ADP employment change, the weekly jobless claims, the JOLTS job openings, and then the big one Friday, non-farm payrolls and the unemployment rate expected to come in at 3.6%. That's the one I'll be really looking at. Fed fund future traders are pricing in an almost certainty that the Fed will hike later on this month. The fear and greed index still stuck in the extreme greed zone. Pretty quiet day in the options market, just 30.5 million contracts traded and still majority of them calls. And it looks like dark pool traders have renewed their interest in the market, with the DIX index climbing to 52% today in bullish territory. And on this shortened trading holiday week, corporate insiders haven't been doing much trading either, but still outpacing purchases. And there's a look at our S&P 500 oscillator, currently with a reading of 55.7. And we can see over this last month, we've got this big clustered overbought reading, which is very strange when you look back in history. Typically when it peaks up there, it doesn't stay for long in these overbought levels. And so that's what's been a bit different in the last month. The market has stayed stubbornly high in these overbought levels. And we can see on the S&P 500 here, which closed a bit under 44.50 today, that volatility is just really calling up, really low range today. And we can see that in the realized volatility index, dropping to a multi-year low today with an implied annualized volatility of 9.33%. However, we did get a little pop-up in the VIX index today, up 3.5% to just above 14. And that was a bit of a divergence from what went on in the market today. Really tight range. Realized volatility dropped off, but we saw option dealers increase the price of premium they need to take in to compensate for that risk. And that's why we've got the volatility risk premium jumping up a bit here today at 4.8 points. And that's the difference between the VIX and the realized volatility index. And we've still got the skew index at 144, and that represents the price of out of the money put options on the S&P 500. And typically that will rise before the market falls over as the market kind of prices in an upcoming correction. A little bit of weakness in the international stock indices out there, with the TSX coming off, the FTSE turning down a bit, the DAX back below its 50, the Nikkei sitting right at its, and the Aussie and China stumbling a little bit as well. A little bit of a drop in breadth today, with 77% of stocks above their 20-day average, and same with the amount of stocks making new highs. On the NYSE it was only 40 today, and on NASDAQ it was 29, which is one of the lowest readings we've had in the last couple of weeks. There's the growth versus defensive sectors pulling back a little bit. Same with high beta stocks versus low volatility stocks, fell back a bit today. Same with small caps versus big caps, bit of weakness there. And international stocks are still really weak versus American stocks, and we can see that in the developed ETF EFA versus the SPY, and the European stocks represented by the ETF FEZ falling to multi-month lows as well. And there's a look at the spread of high yield bonds versus treasury bonds, and that's that strange dynamic we were talking about before, with rates on the march higher and signs of credit markets tightening up a bit. It's a little unusual to see high yield bonds have a bit of momentum versus treasuries. And there's the 2-year yield quickly approaching that big 5% level, where we just peaked out a little bit above that before the Silicon Valley bank crash. And those higher rates is what causing bond funds like TLT to pull back a bit. Dollar's holding steady at 103, and it looks like we didn't get that weekend breakout in Bitcoin. It's still consolidating just above this $30,000 zone here. There's a look at the Commodity Index Tracking Fund, DBC, still stubbornly holding on to this big support zone here. And there's gold, still slowly drifting lower. Did get a bit of a nice move up in crude today to just under $72 a barrel. And over to stock sectors today, there's a look at the cannabis ETF with a bit of a pullback here. And there's the AI ETF bots pulling back a little bit. Did see a bit of green in clean energy and communications, along with jets, which has been really strong lately. The airline companies are all ripping higher, along with the cruise lines and some other travel stocks. And we saw a bit of a move up in REITs, and the winner was utilities. Look at that big move up in utilities on volume today. And just a look at our sector trends table indicator. We can see here with the BOTS AI ETF now below its 5 and 20-day moving average. And there's semiconductors turning down a little bit, and we've still got the weakness in the gold miners and biotech. And still got the strength in those traditional sectors like the energy, industrials, and financials. And if you're interested in learning more about all my custom indicators, click the link below this video and it'll take you to a page on my website where you can watch a video where I go in depth over all 20 of my custom indicators and how you can use them as well. Moving on to popular stocks, we got a little bit of a pullback to JP Morgan today, just sitting right at this big resistance zone. So we're looking for that to hold, for that resistance to then turn into support. So we did get a bit of a volume move above that, and we need to see this hold and ping back up to confirm that this is a real breakout and not a fake out. There's a look at Tesla finishing the day up on a bit of an inside day pattern, and there's NVDA still a little soft on weak volume and on these strong bearish divergences. There's Apple pulling back a bit today, but still in this really tight parabolic uptrend. And similar to NVIDIA is Microsoft, soft on these bearish divergences, and you can see our hidden divergence indicator has gone negative. Google's the weakest stock, technically speaking, out of all the mega cap techs, and Meta is the strongest, actually finding new year-to-date highs today on above average volume. Over to meme stocks, and pretty mixed across the board there, nothing too much to report. And not too many big moving stocks out there in the market today. It was a pretty quiet day out there. And there's a look at Super Microcomputer, one of the best performing stocks this year in the market. And that too has huge bearish divergences showing up on our indicators, the DSI and hidden divergence. And another mixed day for the banks out there, with Charles Schwab just pulling back a little bit. Okay, so there it is. Not a whole lot of exciting news to report to you today in the market. As we expect, coming back from the 4th of July holiday, things were a bit quiet. However, they will ramp back up tomorrow with all that jobs data we're getting, and as well into Friday. And like I said, I'll be paying attention to that unemployment report. So it's expected to come in at 3.6%. And up until last week, we had been seeing initial jobless claims been trending higher. They did come in a bit lower than last week, so we have been getting a bunch of mixed data out there. So the unemployment rate probably will come in at 3.6, 3.7. However, it was 3.8 or above. That would push the unemployment rate above its 20-month moving average. And I've found in history, when unemployment curls up from a low reading above its 20-month moving average, the charts show that recession is just around the corner. So that may get the market a little nervous if we see unemployment rate jump. However, for now, as it stands, the economy is tracking okay, holding up okay. We've still got high inflation, and that's why the Fed should keep the foot on the gas with hiking rates. And I continue to keep my personal swing trading portfolio market neutral with roughly the same amount of longs and shorts. So that's all for today. Thanks very much for watching, and if you haven't already, hit that subscribe button, and I'll keep doing my best every day to keep you informed and updated on all the most important events and news in the markets. And I hope to see you again tomorrow afternoon. Thanks.